Hello, everyone, and welcome to another episode of Stable School Podcast, live from Cannes. I'm your host, Raza, head of growth at Scroll, and I'm here with Behrin from Neutrl. Did I pronounce your name correct?
That's perfect. Yeah, and great to meet you, Razan, for having us also.
Please take it away, introduce yourself, and introduce Neutrl.
Thank you. Yeah, so I'm Behrin, the founder of Neutrl. Neutrl is a new protocol, not fully public yet. But what we're doing is we're tapping into the price dislocation between normal spot markets and OTC discounted markets to try and bring a very sustainable yield on chain. That's usually previously only been for big institutions in the space.
Yeah, and that's what I love about crypto. You know, we're basically providing access to retail where it's usually you have to jump through hoops. And I think that this is the biggest innovation, or like the innovation I'm really the most passionate about. Double clicking on that, you hear this new term that got coined, like synthetic dollar.
Yeah.
Does that apply to NUSD?
Yes, so I would not say we're a stablecoin. We're synthetic dollar. I'd say synthetic dollars over time, to be honest, to like give you a bit of backstory. I'm sure you're very familiar with it, but for others, Athena largely is the kingmaker in the space. Before them, there were no such thing as real mass adoption synthetic dollars. They created like a delta neutral peg on Ethereum initially, and then Bitcoin, and then moving across into like treasuries, etc. Now, they created a market from zero to like $6.5 billion last year. So Neutrl NUSD will be a synthetic dollar of like a similar format. Yeah.
So I like this approach. Let's assume folks don't know what a synthetic dollar is. You explain it. But for regular folks, if I explain a stable coin, I just basically tell them it's a digital version of a dollar. They sort of like get it. You have $1 locked up, unlocks it or mints it on a blockchain. How does that process work for a synthetic dollar? And what collateral is it backed against? If you can explain a bit of the mechanism.
Yeah, sure. So the difference with synthetic dollars is different formats, but I think I like to keep it to the ones that actually have adoption and I think makes sense as well. So USDE, for instance, created the synthetic dollar where the collateral is actually just two open positions on an exchange, where they basically someone would provide you with $1 of another stablecoin, whether it's USDT or C, etc. At the same time, automatically a long position's open on Ethereum, for example, and a short position's open on the Ethereum like Perpetual. So that creates like price neutrality, and that allows you to actually keep this peg closer to one. So it's like a derivative type of dollar that's been created.
And USD works similar.
NUSD will work similar across not just Ethereum or Bitcoin, etc., but any other type of altcoin that actually exists in the market. But it'll be a similar type of mechanism that's been tried and tested. Yeah.
I'm just gonna ask you because if I heard that, you said altcoin.
Altcoins, yeah. So anything from could be Bitcoin, Ethereum, but like anything in the next like top 100 market cap coins in the crypto universe.
Well, that expands the range of, let's say, liquidity you can tap into.
Yes and no. So I think the most liquidity that you'd have, the reality is that you need enough like open interest and trading volume in the markets. So Bitcoin and Ethereum has the most across centralized venues and DEXs. Altcoins have a smaller portion, but it expands the amount of markets that can be tapped into overall. So in the sense that we could play into Bitcoin and Ethereum, but our real niche will be playing into altcoins where there is enough different yield perspective, because we're not just trying to be a dollar that or synthetic that's tagged to one. We're trying to offer the highest yield on chain that really comes from like tapping into these other pairs.
So you already alluded to it, saying okay, you're looking for different sources of yield. How is the yield generated?
So yeah, this is the different part that I think people may find interesting. So we perform a delta neutral trade, which basically means we remove price volatility from the trade. Usual delta neutral like liquid trade, which is done by a lot of funds or even Athena themselves, opens a long position by buying Ethereum or Bitcoin and then shorting the Perpetual. What happens is price is nullified, but because of the shorted Perpetual being provided on an exchange, you earn like a funding rate yield that's paid out to you by the people who went long on the Perpetual on the exchange. So with us, we said, let's take this to a different level that hasn't been brought. The short will still be the similar perpetuals, but the actual long is buying discounted tokens. And this is because of something that exists in crypto private markets called OTC, where large blocks of tokens are often traded between VCs, funds, treasuries, and like brokers. And you can't go to the market and just sell these tokens. Often they are still vesting. And if you actually had to sell them in big chunks, if you're an early investor, you would dump the entire token price. This is even for the top 100 coins, right? Even if you had to do it with Solana, Avax, Sui.
So essentially, you're providing a new destination for these altcoins.
We would be a buyer of these altcoins from foundations and VCs that actually hold large chunks of them. And then we'd use this in our underlying strategy. So our underlying strategy means we use this locked OTC-Backed. We got at a discount between 20 and 70%. And then we short a perpetual. Now, here's the market price. This is where we'd buy this actual underlying collateral. And we short perpetual at the current prevailing market price. So that entire movement there becomes a yield that could be generated over time as we close this, as these tokens vest. Then there's two other parts to the yield: the normal cash and carry that you'd get similar to USDE that's paid out, and then you also can stake this underlying collateral. So it's like three forms of revenue that's generated, and then it's all packaged into the synthetic dollar that a user will be paid back this real trading yield.
Maybe we have a spicy question. Are you not forcing altcoins to like go down then?
I think it's the opposite, because the reality why altcoins often go down if there's big market sells into the market is there's no liquidity. Even if something's listed on Binance or Bybit or OKX or Coinbase International, not all of these venues have the same amount of liquidity. You use market makers to provide liquidity on different exchanges. If it's done in a way where you don't become too big of the open interest of a single coin, of the entire trading volume there, and then over time, because we're using vested tokens, we're actually creating like a smoother way to actually unwind out of it. It's something that's done in traditional finance as well, with like equities and stocks. It's just in crypto, we get a lot of nefarious players that would rather come in like, full stackered, right, or whatnot.
Yeah, we spoke a little bit about that. But like, I find this personally very interesting, so I want to like double click on this. So essentially, maybe providing a destination, not completely the right word, but that's a huge market to tap in. I mean, the amount of altcoins out there, and especially like that don't have utility, you're basically allowing a lot of these backholders to say, hey, you can come here, synthetic dollar, and then am I understanding like this almost seems very good to be true, because me, let's say as like an altcoin generator or something, now assuming I'm in the top 100, I'll be like, cool, let's partner up because this is also good for me.
Potentially, right? I mean, it's different. We would not be doing this with all altcoins. Behind the scenes, there needs to be enough liquidity, needs to be enough volume on the actual token, enough like multi-sex venues, whether it's like the major sexes I mentioned, or even like hyper-liquid at some point, but it can't just be sitting in one place. Also, we analyze these deals, right? So you have to look at like things like slippage that would be taken into account. We're not going to just do stuff on super long tail assets. It'll be riskier for us. And there is a market for it. So like foundations are already doing this, right? They do sell like 9 figures of their treasury, then announce it as like a big raise like 6 months later. Often it's done for good reasons. If it's legit companies, they're doing it to bring in a strategic partner that they want to lock in and whatnot. But I think it's good for our users in the sense that this is being done. Last year, you mentioned it is a pretty big market. It's opaque. No one really knows unless you work closely with brokers, etc. One of our core investors is Styx. They're doing most of the OTC locked volume. Last year, the OTC locked volume market was $8 billion. In the next 2 years, this is like on-chain data, right? You can look at the vestings of tokens. In the top 100 tokens, $55 billion will be unlocked. And you made a point, actually, like a lot of tokens don't have utility, or there's maybe no tech around it or use case. There's L1s and L2s that no one's even trading on. What happens there is that over time, if you looked at last year, we ran these strategies pre-neutral. It delivered like closer to like 40, 55% delta neutral, no price risk return. This is because when you buy the token, you're getting it at 30, 40, like it was like 20 to like 70% discount, but say average like 30, 40% discount. And then now these actual market prices of these tokens are higher. 1 year later, like I have some data on it online, but they're all over here now, between 20 and 88% down even further. So yeah, it's like pretty interesting market. I think it'll get bigger. It's not really agnostic. It's like pretty agnostic on like whether it's bullish or bearish.
Yeah, you know what? It's definitely one of the more novel designs I've heard so far, and I'm actually it sounds very exciting. I do like want to keep you here for a minute on that, because I can't shake the feeling like forcing the coin down, but I can also see at the same time, to be quite frank, it's going in a certain direction anyway. Is that also something, because what happens when the token appreciates?
Yeah, so the biggest actual risk here would be not on something going down. It's actually the way the protocol has to be designed to make sure there's enough liquidity. Like a lot of prop shops and trading funds would do these OTC deals on like a few concentrated positions. Then you have a risk that if the token does like start appreciating and you're highly levered against it, like you'll have to provide more capital for the actual short itself. Like for us, we're thinking of it in a very like diversified way, where you need to have like actual thresholds of what position sizes you take for each individual token. And then also on the margin, like you can't actually be more than 2x leverage. Like then you can actually manage. And then over time, as you make revenue and like an insurance side reserve that we create on chain, like you can dip into that of like yield bearing other type of tokens that we'd have, like some of the other like yield bearing like stables that are available, and use that for like margin. Like overall, I do not see that happening for most tokens, to be honest. If you look at the market and like you run like Monte Carlo yourself on like the last 2-3 years, it's very few times that you wouldn't be able to manage like an individual position. But I still think like having it like across multiple positions is very important. Yeah.
So, are you targeting retail or foundations and investors?
For the use case or for the
I mean, like you mentioned locked tokens, for instance.
Yeah. So right now, it's not public. We've been running with $40 million. It's largely from institutions and other trading funds. We wanted to make sure that we deliver something that is real trading yield. I think that's super important versus like other type of yield that's offered often by projects now, which are in like their native governance tokens and etc. In the next couple of months, we'll be opening it up to public as well.
Gotcha. And so how do I envision that? Because again, in the current design, you mentioned these are locked tokens, you buy them at a discount. So if someone is holding, let's say, I don't want to mention anyone's name, but like an XYZ token, it's not locked, but it's in their wallet, they're not eligible, or how does that work?
So what would happen, the protocol design works similar to how you see a lot of other DeFi applications. Now you'd come onto it on the dApp, you deposit like either USDT, or USDE, Athena synthetic. And in the back end, there'll be positions that are actually open. So we deployed we use off-exchange settlement. So none of the funds are actually kept on like centralized exchanges. Use like something like Copper, Clearloop.
A third party.
Yes, yeah. A third party. And then like actual OTC bags that we bought in from foundations or VCs or treasuries are sitting with custodians that we like institutional proper custodians that we pay a lot of money to, but you can actually see these addresses on chain and we hold it versus like just a piece of paper, right?
Yeah.
And also there's another angle, like we could also create these use ZK to actually not provide like show the actual name of the token, but then you actually proof of reserve, it actually exists there. Transparency will be very important. So we will release like dashboards of all collateral, margin, and actual positions that are third party attested, like overall, like people will be able to see.
So essentially, it's for locked and unlocked tokens.
It is for locked and unlocked tokens. So a user would provide us actual stablecoin. We then use that to buy a different position and trade it. And over time, they would get the yield paid back to them. Yeah.
Essentially, what I'm getting at is what if you hold altcoins, but you can't. So just to be clear, you can't mint the synthetic stablecoin.
Using an altcoin.
Yeah.
No.
Yeah.
We would go. That's what we sift through deals. So it's very important that we work with like our relationships with foundations and treasuries, and then like brokers like Styx, who are trusted, that we actually look at deals that we want to enter into. Of course, people can come to us directly, which they do already, even pre-Neutrl. but we won't accept that as collateral. We enter into the deal with like purchasing the tokens from them.
Gotcha, that makes
that
sense.
we want to enter into.
And so one of the mechanisms of Neutrl is that you can stake NUSD.
You can stake NUSD to get like a kicker to the OTC yield, right? So there's two parts to it. Liquidity is very important even for NUSD because we're building it out with like real DeFi composability. It needs to be on Morpho. It needs to be on. It needs to have curve pools. It needs to be on Pendle and other type of like DeFi platforms, because I think that's how you get real use case and people are more excited about it. So NUSD will actually work a lot more with how Athena kind of works, where it's entered into these delta neutral liquid trades at a paid yield across anything, not just Ethereum and Bitcoin. And then to stake, you need to actually, you stake on the protocol and you get paid the OTC yield, which is a higher return.
Gotcha. And so
that allows us to duration match, because like OTC deals can range between like either liquid to like 3 months, 6 months, etc.
And so how do you hedge market risk?
So we hedge market risk just through Perpetual. So largely, I think the three best things that have come out of crypto from a trader's perspective, not other tech, has been trading venues and tools. Synthetic dollars allows us, and stablecoins allows us to do things, and like Perpetuals, right? Like Perpetuals has more volume right now than spot crypto tokens. It's like 4 to 5x actual like spot crypto tokens across multiple sectors and venues. So we use that. It's super highly liquid instrument to actually hedge out the price risk.
Yeah, I was just looking at my question. You answered my next question. I was like, how do you utilize perps to like essentially hedge the market risk? Like maybe taking a step back, how do you view the rise of all these stablecoins?
All the stablecoins.
Yeah, and let me like make
it's a meta, right?
Yeah. Like to me, like this sounds probably almost dumb, but a stablecoin is obviously not a stablecoin right now. Even in like NUSD at some point,
it's not a stablecoin.
It's not but it will be classified as stable. Someone will be like, "Oh, I got into the stablecoin NUSD." Even people when we talk about Athena, right? You mentioned people will be like, "Oh,
it's a stablecoin, but it's a synthetic dollar." Yeah, I agree.
And so the question is what's your take on the rise of these stable coins? Is it good? Is it bad? What are we actually experiencing right now?
I honestly think it is a rise, partly because obviously TradFi has come in and like Circle, etc. So people see that. But even previously, before that, it's one of like the few asset classes that actually have like product market fit in crypto. I mean, I've been in crypto for a long time, like DeFi, pre-DeFi summer. There's a few OG protocols that are still amazingly like doing well and like moving the space forward, partnering with like TradFi, bringing in like institutions like BlackRock, etc. Stablecoins or synthetic dollars can either be, they just still have the best use cases, remittances, ability to actually earn like yield in this type of vehicle, like almost like a internet dollar that's like a savings vehicle that's tapping into it. I think there's too many, of course, but I still think there's great projects out there that are doing amazingly well, like Athena, like Resolve as well, and a few others, right? I think what's important, though, is that people mustn't confuse like a synthetic dollar or stable coin with something that's hard pegged. I think it's very dangerous when like projects do that. Like just say, okay, my thing is worth $1, but why? Like really? And the people can get wrecked on that aspect if they use those type of products. And the other thing is like you need to make sure there's enough liquidity for these dollars that are created that aren't like a Tether or like a USDC like type of dollar, right? I think Athena really created a great angle, and they obviously created a lot of people that wanted to copy them after that.
A lot, yeah. I think that
we spoke to the Athena like team before deciding whether we could even do this. Like to be honest, like,
can you provide some insight to that conversation?
Yeah, sure. Because I think like realistically, this could have been a prop fund. We would deliver very good return and yield. It's a strategy that is done by very big market makers, prop funds in the space. Like most of us know their names. And I was like, it's not really that exciting to earn like 2 and 20 and just like a normal fund, because it's still creating the same opaqueness you can't actually do enough size at some point. Like, so if there's $55 billion of tokens unlocking, you actually need to pool more capital. You get to access even better returns and deals. But is this something that can be made into a synthetic dollar type of vehicle? And like, we were grilled by the team, of course, which makes sense. And at some point they said yes, but there needs to be like a lot of like things that need to be right, like transparency, risk management, liquidity, insurance reserves. So those are things that we take into account, like any type of feedback from any OG like protocol in the space, and we will like build towards that.
What do you think the future holds for yield-bearing stablecoins?
I think it's gonna be very big. Like, I think because you're seeing a lot of like other like TradFi institutions coming in now. They could all implement these type of yield-bearing stable coins even within their backend onto like their mobile wallets or like digital banks, etc. It's basically a savings vehicle. For often that's worth $1, right? To some degree. That earns yield. Yeah.
Isn't that a bit wild? You know what this reminds me of? This is like a complete tangent. It reminds me of Reddit, when they probably had the most toxic community about NFTs, called the digital collectibles, took off. And essentially like stablecoins came to existence to allow, let's say, a currency that we know like off-chain to live on-chain. And it, again, like as the name suggests, it provided like a sense of stability. And stability in the sense of most crypto users are used to a lot more risk. And so for me, it makes a lot of sense, like this growth in the yield-bearing ecosystem, whether it's LRT, LSD, and even stablecoins, it makes a lot of sense. It almost feels like, and it actually is the space is maturing.
Yeah.
But these kind of products to me are more like, and I love them, but they don't feel like stablecoins or even synthetic dollars. It feels like these are wrappers for financial strategies, products, or DeFi strategies, yield strategies.
Yeah.
But then like it's pegged to $1. And it feels like, I'm holding still $1 while my capital that I basically gave as collateral is working for me to
earn on it.
Yeah.
Yeah. So I think that's why I think there's very different mechanisms. Yeah. So the actual like financial instrument of like creating an Athena types USD synthetic dollar actually makes sense because you remove price sensitivity. You have the underlying collateral backing it. You have to buy the underlying Ethereum and you have to short the Ethereum perp, right? It's sitting there, $1 worth of that on each side of the trade. So, and if you unwind it, it's $1, right? Also, I agree with you. There's a lot of like stable coins or synthetic dollars that are coming out and they just like wrappers of like RV stuff.
So money market fund.
Yeah, they're money market funds.
You're attracting capital essentially and saying like
and
the receipt token. Yeah, I'm pegging the receipt token.
Yeah.
Which is essentially saying
it's
like
dangerous.
It honestly, like right now, I think I just came to the like didn't just came over, like it's been an underlying gut feeling where I'm like essentially this is what it takes to like one, attract investors, and two, attract retail to be like, hey, this is where you put your money because don't worry, it's still $1.
I don't know about that, right? Okay, look, even with our investors, yes, it's a meta, so maybe people want to get in on that. But our investors all asked like tough questions. They asked, and we didn't just take in money from anybody. We were fortunate we had options at the time. We brought in like DeFi strong investors as well. And like that's what there's two aspects to it. The first part of it, NUSD can be close to $1, but it's not a hard peg. It actually needs to trade based on the actual underlying instruments, like similar to USD. And the staked NUSD can't be a hard peg either. It needs to trade. That needs to be a bit more flexible. So the NUSD will be closer to 1 because of the underlying.
But you said not a hard peg. Can you like?
What's a hard peg?
Yeah, just like how I liked at the start, you were like, for the audience, I think that this is another one of those things, right? Let's dive into like hard versus soft peg.
Yeah, so a hard peg is largely in your code where you're basically saying like the underlying that was received is just written at $1, right? A 1 like value. There's a lot of protocols that came out, like some big ones where the actual underlying is like a treasury bond, and like 4-year maturities, and they're saying it's $1. Like realistically, if you just like this kind of cash flow and finance, that's probably like closer to like 86 or 88 cents or something. but they pegged it at 1 on the code, so people can then use that dollar across Pendle, across Morpho, Aave, etc.
It's just a price fee.
Yeah. The dangerous thing there was like, obviously at any time, the collateral's not actually worth 1, and the team can change it, which happens. The soft peg is largely more where you're allowed to float based on the underlying instrument value. And I think that there's certain parts where $1 will be like similar, even like USD isn't 1, but it's close enough to 1 because of how it like trades, the 2 underlying. So NUSD can be similar to that. But the staked version of NUSD will have more locked up like portion to it as well as liquid portion. So you have to take that into account, like on cash flows that you expect to receive.
Do you think that this will reset at some point? People will be like, okay, we need to stop calling this stablecoins and we need to stop call it like...
We should stop calling it stablecoins. Like we actually like, people have been saying NUSD as a stablecoin. I keep saying it's not a stablecoin. Yes, it can be used in cross DeFi.
Yeah.
Similar to like USD. USD isn't a stablecoin also in my mind. Like, no offense, like anything,
Yeah.
but it's a synthetic dollar.
Yeah.
But then what is a synthetic dollar?
I was
What's
gonna say now you're opening a whole other can of worms, because essentially what a stablecoin means to me, it's a crypto token that is just like valued at all times and safeguarded at all times.
But then if somebody said on the code, like without the underlying collateral, like this is $1, is that a stablecoin?
No, so you raise a very valid point, and I've been talking about it, let's say, for the past 2 days, where I'm like, So when I say I see the rise of all these stablecoins, and I come from TradFi, I come from the banking world, I don't like regulation, but transparency is lacking.
Yeah.
Where's the legal entity? Who am I doing business with? Solvency, like what's the solvency ratio? Like, what's the basket of collateral that you're actually holding? Where does the yield come from? So for me, don't get me wrong, I'm super excited, and I'll just call it all stablecoins or synthetic dollars.
It's still good overall, I guess. That's why we okay for now to say it, right? But I think like you guys as well, and like I was at your summit, and then like even listening to the podcast of other like projects that have come on, I think you can see the difference between like real like builders and like people who understand it versus like in general, and like education is important, right? I guess to some degree.
Yeah. It just feels like the crypto thing that we're doing. Let's just like slap a label on it, and then at some point it just reaches the masses, right? And I can just imagine like, every ticker is used, but like XYZ USD, right, becomes very, very big. But like it's not a stable-coin, nothing near a stable coin or even a synthetic dollar.
For me, if it reaches the masses, like Neutrl, I don't want them to be calling it a synthetic dollar or stable coin or anything. I just want them to know they're going to get real trading yield by providing $1 or something. You're actually getting real trading yield back, not something will be paid back to you in like something you could be used for real money, right? Versus like another token emission. Because I think the labels also are confusing in general. Like for us, yes, we deal with all of this, but if I had to ask my mother what's a stable coin, bro, like...
I've been trying, I've made it a ritual. Like once, like every quarter, I had to exit with the family and stuff.
Okay.
It's funny, like I just came back from the Netherlands. I told you, like, and I spoke with my sister, explains stablecoin. She's like, oh, it's still crypto. I'm not touching it.
Exactly. That's why I don't need it to. The technical stuff is not important as long as it's safe, transparent. You mentioned solvency is super important on these type of things, and people just feel like they're getting real yield. I mean, there are a lot of institutions coming out now that are digital banks or a bit more TradFi focus, or even like create these wrappers. Like you don't know where the yield is coming from, but like generally they also need to like implement yield onto their platforms for users. And like if someone can understand that, okay, this is real crypto native yield, like it's real yield trading, they don't need to understand it's a synthetic dollar or stable coin that's behind it, but you can actually implement it. And it just help the entire industry probably grow over time, right?
Honestly, it does get me excited though. I think that it's like, it feels like the next frontier. Maybe I'm exaggerating, but it's just, and I think that's, don't get me wrong, correct me if I'm wrong, it's at the heart of Neutrl. It's providing access to retail to these possibilities that usually is like, not gate kept, but like it's just not available to the larger public in terms of like when you look at OTC deals or, the exposure. So I think that it is part of the promise of crypto where, you're essentially saying we bring a traditional mechanism on chain and now anyone can use it, but we still do rely on intermediates, like we would rely on Neutrl being like a party that deals with third parties that are custodians to, let's say, these altcoins, you having the right hedging mechanisms in order to safeguard, let's say, not just the collateral, but also ensuring that essentially you'll be able to deliver on the promise of the yield. And then it goes even further. And maybe that's a question. Do you even care whether it's pegged to $1 or not?
I don't think it needs to. We're not. There's no hard peg here, right? It's backed on basically how the financial instruments will operate. I think it's important to have some sort of usability and DeFi composability. That's where a lot of teams like strive to say, okay, this thing is worth $1. Then you can use it on other platforms like DeFi degens, then go and over leverage, or they'll like chase points on certain things. And like there were protocols where people knew that it was also hard peg and they still did it because of these programs, right? So there's like it's important for like projects that want to build long term, like realistically, not just like quick type of things, to make sure people understand how it's actually made up, why is it close to $1, or why is it $1, or why is it more than $1, like at certain periods. I think that's more important than just using something a bit more degenerate. So I guess I do care in that aspect, but not to peg it.
Yeah. So Neutrl in beta you mentioned right now?
Yeah, so right now we have been live. The team's been together for since last year, running strategies, but Neutrl as a concept's been live for about 2.5 months. We're running 40 million right now. We don't want to take in retail money until we are really sure everything is working correctly. But in the next few months, we will open up. We are currently doing audits on the DeFi side with some really top auditors. And yeah, we're really excited. And this is the first time we've introduced Neutrl, literally this last weekend, to the outside world, I guess. So,
what does the timeline look like?
The timeline, I think, is pretty soon for the public access. But we need to make sure everything is working very secure. We're not just trying to rush something to get it out there. But the team is pretty on it at the moment.
Honestly, I've just been looking at the questions, and I think I've covered most of it. I actually want to ask you: do you feel like you want to share something, because this is one of the most exciting conversations actually I had.
Probably because I never got the questions right.
That was staged. But genuinely, I think it's also, to be quite honest, it's refreshing. I think that. I think that there will be some form of a reset. At some point, we will say, these are just financial instruments. We just labeled them like something dollar, something stable, but these are just financial instruments, and abstracted away, and have made it available for give it a label to retail that they understand or feel comfortable with.
I think you're 100%. I'll be very happy if that happens, to be honest. For instance, some of the people that have given us money over the last year or so aren't crypto people. They're actually traditional finance funds. They don't know what DeFi is fully, right? I also feel DeFi is capped overall in general. There's a lot of liquidity moving from protocol to protocol. The only way to grow is to actually bring on traditional finance. And we've been saying since DeFi summer, right? But the way we pitched to some of these institutions that provide us money was basically saying, doing OTC and then removing price risk because of the strategy, it's almost like distressed test investing, and these are the type of funds, and they're okay, this is the risk we can handle, and what is a yield that you probably would get? We're this is what we got last year, this is what you'd probably get. They're yeah, no price risk, I'll do it. I don't sell them on a synthetic dollar, right?
Yeah, but honestly, that makes a ton of sense, and I think we will get there. I mean, at some point, people are already asking, okay, what's the difference between these two stablecoins, or why is the yield higher or lower? I think that we'll get there. The need for information.
Definitely, yeah.
There's a lot of need for information, and I think that's also where you will find legit players who stand out as well. Oh, I'm incorporated here. This is the team.
100%.
This is our strategy.
Doxed. Yeah.
Doxed. Yeah, I mean, honestly, I think that's the way we're going. But it will take a minute, but I am excited. I think that what is cool is all these structures coming on chain. I will tell you this, and this is my last question, and then after I will, bro, doesn't it scare you a little bit as well? Because it feels like, so maybe this is the TradFi, like the old dude in me speaking. It like, when I talk to old buddies of mine, I think, wow, I can never go back to that world. Overregulation, reporting upon reporting, millions and millions, each and every bank and insurance spends, I don't want to quote a number, but millions and millions in just paper reporting, right? And then right now, when I'm seeing all of this going, like when I explain this to some of my friends, they're just essentially saying like, yo, you've got people who didn't study, not licensed, basically our asset managers.
Yeah. Sometimes like two people that are like, I mean, they may be brilliant.
So that's the cool thing, right? But there's also there's a flip side to this.
Yeah.
Which is like, you know, now you have amazing tech, but you can like start a money market fund, boom. And I mean, I don't know.
I think what will happen is that, look, like our entire team was ex-TradFi and then worked in like market making, crypto specific afterwards. And they all worked in like big US banks before that. But no one knows that, right? And I agree to your point. Like people, like a label, a brand, you don't know what's actually behind it. I think what will happen is, unfortunately, like a lot of people will get burnt, like on a lot of like random projects. But if there's like really solid projects that there are now, like that exist in the space that are already live before Neutrl, you will see like traditional finance come in. They do much higher DD. There's a lot of like regulation around it. And if you're actually really serious as a project and you want to like break into it past just the crypto like sphere that we're in now, you'll put a lot of effort into like hiring people and doing the right like things regulatory wise and working through. But it's hard to like it's like it's the ethos of crypto, right? You can't really stop anybody.
Yeah, it goes both ways.
Yeah.
Behrin, it was an absolute pleasure. I think that you know, I could go on for a minute chatting to you.
Appreciate
I'm
it.
extremely excited to see where Neutrl is going. We'll keep a close eye on it. You need to come back and then tell us like how everything went. I already asked you about timeline. You said soon. We'll keep it at soon. And yeah, thank you so much.
I appreciate it, and thank you for inviting us. And it's always nice to have a candid conversation, right?
Yeah, for sure. Those are the better ones. Thank you, Behrin.
Cheers.